In 2009, the market, the S&P 500, the Vanguard Index 500 fund, was up 27.11% in 2009. So you can easily look in hindsight right now and say, I'm glad I held in there, because 2009, the markets did great. 2008, I got crunched and I was thinking about getting out. But in 2009, I'm glad I held in there because it worked out fine. Okay, let's look at this a little bit though, my friends, shall we? Because this is where it gets, again, like I talked about yesterday in 2011, where the market started the year up 7.5%, quickly went down, but down about 20% between, I think it was the end of April to the end of beginning of October, and then came back up again to end the year at basically a zero, roughly 1% on either side, depending on if you're reinvesting dividends. 2009 is another story just like that. So let's look at 2009. We'll talk about this here in just a second. Here's the S&P 500 in 2009. It was up 27.11. That's why it's green. Started the year at the end of 2008. The S&P 500. This is the VFINX, the Vanguard S&P 500 index. I'm not using the S&P itself. I use the index fund because you can buy into the index fund. You cannot buy in the index directly. So I always use the VFINX. Now that they shut it down to new investors, it's all going to Admiral shares. We'll probably still have to use VFINX because it has a track record dating back to, I think Bull will start that in 73, 74. But again, you can't buy into this fund anymore, is my understanding. You have to go the Admiral shares, which is fine. I got no problem with that. But the track record of the S&P 500 index is what we're shooting for, and that will be this fund right here. So VFINX. The end of the year 2008, and this is after getting killed. I think it was down 37% in 2008. The end of the year at $903.25 a share. Now, from the first trading day till 3/9/09, it fell from 903 to 676. That is down, I think I have 25%. That's a 25% decline, my friends. From the end of 2008 to 3/9/2009, it was down 25%. So, as you sit here today in hindsight, say, oh man, 2009 was a good year. Recall your thought process. This is Obama had just been inaugurated. You know, he didn't know that he was a senator for what, 2 years, I think, and he was a state senator for 6 before that. So he was a rookie. His campaign guys were pretty big on the left for sure. The Democrats had unfettered power, 60 seats in the Senate. I think they had like 270 seats in the House. I mean, just huge majorities in the Senate and the House with Obama, a lefty, in presidency. We had Helicopter Ben dropping money on banks to loan. I can't remember if Paulson was still in there or not. Hank Paulson from a Bush's guy. Just not, anyway, that guy, he knew how to take care of number one. That was Hank Paulson, that's for sure. So things look bad. Barney Frank and Charles Rangel were running the show for the Democrats. You had Pelosi as a speaker. Barney Frank and Charles Rangel. Rangel was the head of the Finance Committee, House and Ways and Means Committee. Here's a tax cheat. He's running the House Ways and Means Committee. And Barney Frank from Massachusetts, I forgot what committee he was running. But anyway, things were looking pretty scary. On top of that, we just lost 38% the previous year. On top of that, we're still in Iraq, which is an unpopular war. A lot's going on. Now, there was a lot of feeling good about Obama. And hey, I mean, at the end of the day, you can't blame people. We look for a change, and you got it with this guy. From a financial market perspective, though, things are looking scary. No other way around that. No other way around that. And so by 3/9/2009, the market had fallen another 25% on top of the 37% it fell in 2008, on top of what it did at the end of 2007, which a lot of people overlook too. From October 2007 to the beginning of the end of 2007 was a bad time as well. So as you're sitting there in 2009 in March, please do not tell me that you're like, oh man, this is great. The market's way down. I can't wait. I mean, I'm sure there are some of you out there. I guarantee the vast majority of you, including yours truly, was just saying, man, I just got to protect the bottom line. I got to protect it because this is nuts. This is going bad. We're going to hell in a handbasket here. It's just getting worse and worse and worse. I got to protect the bottom line. So if you would have pulled out there, you would have locked in all those losses. But now at the end of the year, the market went from 676 to $1,115 a share. So it went up 65% from 3/9/2009 to the end of December. Barney Frank, the hero that he is, believe it or not. Everyone gets mad when I say that, but Barney Frank, the savior of capitalism, So from 3/9/2009 to my mic. Oops, hopefully that didn't make a crazy noise there. Check, check. I can't hear it being checked, so hopefully that didn't blow you off. All right, so we are up our 65% at the end of the year from the doldrums of 3/9/2009. Now we still clocked in a 27% gain, but did that really truly reflect the nature of the market? The answer is no. I mean, the market had a good year for sure, but had a great year from 3/9/2009 until the end. It had a scary, scary year that first 3 months in March. I'm telling you, I remember it like it was yesterday. I'll say this story till I'm blue in the face. I was working at USA in San Antonio. I was driving on 10, going from through Helotes, De Zavala. I think it was what the De Zavala was. Had to get off at De Zavala to get some gas. I was listening to Hugh Hewitt radio program, and he's interviewing Brian Westbury from First Trust Advisors in Chicago. And Westbury was saying, "Hey, they just got rid of mark to market." And I remember it's like it was yesterday. Westbury said this is a big deal. Now he didn't predict the market was going to take off like a rocket like he did, but he said to Hugh Hewitt on his radio show. I remember it like it was yesterday. It's like, you think about where you were 9/11 or when JFK was shot, whatever. I remember this like it was yesterday. Getting off of De Zavala to get gas, getting back on. It was in San Antonio. It's still hot in March. I remember it's like, man, I had the windows down, but it's still a little bit hot. And my car didn't have air conditioning. The air conditioner was broken, and we weren't doing very well financially, my family. And so we were trying to protect what we had, because we're like, man, we're just one. If we get laid off, we're done. We're done. And so I just remember thinking, I don't have the money to fix the air conditioning. I'm throwing good money after bad into my portfolio at USAA. Just scary. I mean, it's scary, man. But I remember hearing Brian Westbury saying, regardless of what you're feeling about Obama or Barney Frank, the facts are getting rid of Martin. I'm putting words in this guy's mouth, but the essential is this: getting rid of mark-to-market accounting is a big, big deal. And I didn't believe it. I didn't. I still had money going to bonds. I'll tell you right. I said I got to protect what I have in case I get laid off. If I get laid off, we're doomed, and we just can't have that. Which is another reason why, when markets are volatile, you want to have some safe money on the side. No other way around that. And I didn't have enough money to make it worth. I mean, again, we were down to essentially not very much money left for this old Scanlon family. But at the end of the day, I was putting money in, so I was getting advantage of that 65% increase on dollar cost averaging. But it was minimal to begin with, and so it was minimal going on the upside. But it's easy to overlook how bad that was and how trying that time was, and that affected me deeply, my friends. That was for me almost the similarity of someone just retiring right now, because for me, I was if I got laid off, it's done. Same thing with you, just about ready to retire. If you have one more bad year, you're in a world of hurt. There's no other way around that. And we're already down 20% from where we were at the end of September. I get it. I get it. All right, so I had a guy, one of my clients, a friend of mine, I consider. The guy's telling you about the Ranger School story about the other day. He told me about the Vanguard. He asked me what my thought was on the Vanguard Inflation Protected Securities Mutual Fund. And I hadn't given it much thought because, frankly, I don't like bonds, and I don't like bond funds even worse. And of all the bond funds I like, the only one I really like is the Vanguard Ginnie Mae or the USAA short-term. I think it's the USAA short-term tax exempt. I forgot the ticker of that. But those are only really two bond funds I like. So I said, let me dive into this a little bit deeper. And this is VFINX, a Vanguard Inflation Protected Security Fund. I'm going to do a lot more videos on this using these two in conjunction. I think you'll get a lot out of those videos, because this really is, there's some good stuff coming up. I'm telling you, it's going to be awesome. All right, so in 2009, the VFINX started at $9.15 a share. And at the end of 3/9, it was down to 9.07, so it lost 8 cents a share. So I think that's, I don't even know what that is. What, 3 cents, 4% or something like that? I don't even know if it's that much. Hey, it was down a little bit, no other way around that. But then it came back up from 9.07 to 10.13, which is, what's that, about a 15% or so, 10%, maybe 12% increase from 3/9/09 to 12/31/09. And it clocked in a 10.8% gain that year. So 9.15 to 9.07, that's down 8 cents. Off the top of my head, I can't remember. Let's say 2% decline. From 9.07 to 10.13, that's about 12% increase. and thus it netted 10.8% for the year. All right. Now in 2008, this guy was down. I think it was 8.2%. I have the numbers, and I'll do about 3 or 4 more videos on using these two things in conjunction because it's awesome. I'm telling you right now. So I tell you, I became a believer in VFINX. Because it is inflation protected, and inflation on bonds is the biggest enemy you have, my friends. You park $100,000 in a bond, you come back and collect that money 10, 20, 30 years from now, you will get $100,000 back so long as that bond doesn't go bankrupt. But it ain't going to buy you the same $100,000 did when you invested in it initially. That is the inflation is the bear of bonds on top of taxes. So that's why I have taken a new refreshing look at the inflated protected securities fund that Vanguard offers. And we have a nice track record going back to 2001. And I got lots of numbers on my spreadsheet right there, and I can put them all on the whiteboard as we go through the next couple of days. I think you'll get a lot out of it, especially when we use the S&P 500 and the VFINX in combined in various allocations and whatnot to see A, the downside risk protection, and B, the upside protection as well. So stay tuned. A lot going on there, and I can't wait to share that with you. It's going to be fun. So don't forget to subscribe. A thumbs up always help me. Comments down below. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks, guys.